Thank you for joining me. I'm Alex, and I would like to talk to you about PayPal today. And PayPal is a good candidate of explaining why the old school approach of evaluating stocks does not quite work with the new types of businesses, like internet businesses and all kinds of things that can grow in a major way without really a lot of investment. So what PayPal does is online payments. They're trying to get into banking and stuff. They're also international. I don't even know how many countries they're in, but they're in a lot of countries. And they do PayPal, they do Venmo, and they do other things. Currently, the price is $170, $107, up about 1%, so 4 times the market. PE is currently 51. So already you can see that for a value investor, the PE is just way too high. But we'll get to that later. Dividend is 0. Payout ratio is also 0, shockingly enough. Revenue is about $15 billion, up 20% from the previous year. Earnings $2 billion, up 10% from the previous year. And both of them have been very consistent over the past several years. Total assets $43 billion, total liabilities $28 billion, and net tangible assets $8 billion. So what I wanted to talk about mainly is that generally when you evaluate a stock, you look at the PE ratio and see if it's under or near 20. And so you look at the payout ratio and the dividend to see if you can make your money back in a reasonable amount of time. So a PE ratio of 20 means it takes 20 years to double your money. A PE ratio of 51 obviously means that if everything was stagnant right now, it would take you 51 years to recoup your money or double your money, however you want to look at it. So, but you can see that the revenue increased by 20% despite the PE of 51. So there's a lot of things that can influence the growth that does not cost a huge investment. So what you kind of need to do then is to put the earnings, the earnings growth, the revenue growth, and the PE into perspective, which means that an earnings growth of 10% obviously means it only takes 10 years to double your money. Obviously is going to go a little bit slower because the PE is already at 51, but still, you would assume that if they grow 10% every year for the next however many years, that the PE would probably stay around the same, because the PE tends to be justified by what's going on with the company and what they're doing and how they're doing it, how they're growing. And so if the earnings growth is 10% per year, obviously it's kind of like a PE of 10. So I think that needs to be discounted somewhat because of the high PE that it has already. But I don't think that a PE of 51 really should just disqualify the stock from an investment right now. So with that said, I'm not investing in PayPal right now because the PE is only slightly too rich for me. So with an earnings growth of 10%, that means the PE is dropping by about 10%. So it would take 5-ish, 6-ish years to get the PE into a reasonable range for me. And if we're talking revenue growth, it's going to be far shorter. So it'll take like 4-ish years to double their revenue, which would cut the PE in half, obviously. So that would be around 25-ish. That is if the earnings growth is the 20% that the revenue is growing, which is not an unreasonable assumption because they could obviously reduce the overhead somewhat, and more business, more revenue does not generally mean that they need to increase their spending for that revenue. So with that said, it's still slightly too rich for me. So for a dividend investor, obviously this is not the stock for you. For a value investor, obviously this is also not the stock for you. And for a growth investor, I think it's a solid stock. I think there's probably better stocks out there for you. So if you're looking for a good investment for a growth stock, I don't think this is the stock for you. But if you're looking to diversify, I think you should definitely look into this. I think it's a solid stock. I think that it's a very safe stock. And I think that it would make a good foundation for a growth portfolio. Anyway, that's it for me for today. If you like this video and you haven't already, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.